Good morning, everyone, and thank you for joining us for our quarterly economic update, hosted by Pareto and Alex from Luna. This morning, we'll be looking at what's been happening in the global markets and the economy and the impact this has had on clients' investments. We're going to have an interactive poll for the first time. So Alex is going to launch this.
All right,
There's three questions, if you don't mind answering them. One on what are clients' investment concerns? Which of these areas do you consider the highest priority in the current environment? And which factors are affecting your economic outlook right now? So, despite the backdrop of heightened geopolitical tensions last year, and obviously this with Davos and Trump with these renewed tariff threats, equity markets in the US, Europe and Japan have continued to push to all-time highs. This has been buoyed by strong corporate earnings and resilience to economic activity. The flip side to this is the optimism of the markets is the anxiety in the geopolitical system, which we'll touch on and look at unpacking today. So today, Alex and Chris will be looking at the breakdown of what these trends means for investors and financial planning. We'll look at some market performance, monetary policy, the dynamics of that, inflation, interest rate drivers, and the broader economic growth outlook. So let's begin with the global economic picture and how recent developments are shaping the environment. To talk about this, I'm pleased to, for our regular listeners, everyone will be attuned to Alex Brandreth, Chief Investment Officer from Luna, also one of the UK's most influential fund selectors, according to Citywire, and Chris Isaac, Chartered Financial Planner, who specialises in working with owner-managed businesses and professionals. So just before we start, some housekeeping to mitigate any background noise. Can we please make sure that we're all on mute? The presentation has been recorded and will be available online via the various channels. The presentation should last around about 40 minutes with a Q&A at the end, and there's a Q&A button at the bottom. So, Alex, with regards to the global economic picture, do you want to just run through some of the recent developments that are shaping the investors' sentiment?
I can do. I mean, it seems to be changing on an hourly basis at the moment. Let's just start off with the global trend is that economic growth around the world is pretty robust. Last year we had lots of things thrown at us globally, whether it be conflicts, whether that be tariffs, and the global economy grew by about 3% last year. China at 5%, the US at 2%, UK, Europe, and Japan by about 1%. So it wasn't a bad year. It's nothing to be jumping up and down about, but it was an okay year. And as we go into this year, we're expecting more of the same, really, if not maybe a little bit better in the UK's case. If you go back to when we came into the beginning of last year, you had the budget overhang that had come through, national insurance has just been increased, and that's had a big impact on the employment market in the UK, but also economic growth. So as we start this year, you haven't got that overhang. Now, what's happened already this year? I mean, it feels like it's been a year already in just under a month. But you've had issues with Venezuela. You've had Trump going on about Greenland. You've had how Europe have responded to that, potential tariffs that have come and then were threatened but then removed. And then overnight, you've had Trump threatening tariffs on both Korea and at the weekend Canada. So it's a world where I think we need to get used to uncertainty in terms of this is not going away. I mean, we know what Trump's like, and this is driving global markets at the moment. But it's just noise. I mean, it's a lot of noise, and it's all over social media, it's all over the news. But that's going to be key. And I suppose if we look forward this year, you've got the midterm elections in November. That's going to be a big event. This is potentially going to handcuff Trump in terms of what he can do for the rest of his term, potentially. I think he'll sure find a way around it. And in closer to home, you've got the local elections in May, which are catching headlines for the wrong reasons closer to home as well. So,
and it feels a little bit like in America, the midterms elections are coming a little bit sooner than what it was previously, what it was due to be. There's a lot of pressure over there on Trump recently, isn't there?
Yeah, his popularity has fallen quite significantly. I mean, the US stock market is all-time high, so he always looks at that as a barometer of success. So you could say so far he's been quite successful, and he'd argue he's ended 25 wars. When in reality,
26 now,
yeah, exactly. So there is some positives in terms of what's being done. And look, I mean, who knows what's going to happen between Russia and Ukraine? But that could be a good positive. And then, sorry, just final point I was going to make is we go into this year, you've had several interest rate cuts last year. The effect of that should be felt this year because it takes a while for interest rate cuts to be felt. So that should provide a positive, principally in the UK and US. And then also you've got further interest rate cuts coming this year in the UK and US. And you've got governments supporting their economies fiscally. So you've got both fiscal stimulus and monetary policy stimulus, which should really help as we go into this year as well.
Okay, good. And Chris, how have you seen that affecting some of our clients' behaviours in terms of investing, and what should they be thinking about?
Yeah, it's an interesting one, actually. I think there seems to have been a bit of a disconnect between probably what's happened in markets. I know, Alex, it's been a good year in markets. Clients' portfolios have had good years, but it feels the whole year and coming into this year, there's still a sense of nervousness. I think there's a bit of a disconnect between probably what it feels like in the UK economy, and then when you see, even I think you know better than I do, Alex, FTSE 100, the UK stock market was up 20% last year, but I think that certainly the sentiment still feels quite negative, and obviously portfolios are more globally diversified, but I think that's certainly sitting with clients, it kind of, you sit and go through what's happened in the last year, and you reel off actually what's happened in terms of tariffs and everything you've touched on, Alex, and yet the portfolios have had good years, and the outlook still feels broadly positive, and that's something that kind of doesn't always stack up. But it's an interesting one, really, because I think clients are never really confident in a sense. If you've had bad periods in the markets, they'll think it gets worse. When it then rebounds, then actually often the thought is, well, if we've had a good year or we've had 2 good years, surely it's going to fall again. So it tends to be a bit of a constant fear of market volatility. But I think that part and parcel of investing and being at the right risk profile, so that when there is volatility like back in April, that you might not be comfortable or happy, but you're willing to withstand that temporary pain to then get the returns that we've had over the past year.
Can I just pick something out that Chris said I think is really important? The time to be worried about investing is when you've got euphoria and everyone is positive. And if people are still worried, that's a positive sign to me, because it means that people haven't got complacent, markets haven't run away too far, and people are still being objective. It's when that disappears, that's when you should be cautious. And the last time I remember that was 2007, really. So just before the financial crisis. I don't think we really got to that point just before COVID, because COVID was such a shock. And maybe after COVID there was a bit of euphoria, you had that bounce back, but 2007 was the last time.
It was very temporary, wasn't it?
Yeah. So again, in terms of looking forward, I think that's another positive for as we go through this year.
And Chris, you just mentioned time in the markets. We remember the first 2 quarter webinars that we did last year, and we had one at the beginning of January, which we'll get to over. So the budget and looking at what's going to happen, and then we had the one in April when the markets and the tariffs had just been hit.
Yeah.
Then we were saying it's about time in the market, making sure you've got a well diversified portfolio.
Yeah, absolutely. I mean, I might actually just share a slide on that, if that's okay, just to highlight that point about market volatility can come at any time. And so I'm just going to share this. So this is various equity markets last year. So you can see here that markets were all hit in April. The US got off to a terrible start. So the light blue line and the dark blue line are the US markets. Japan also in yellow got off to a terrible start. Europe and China actually got off to quite a good start, as did the UK. Couldn't cash your mind back. They also had DeepSeek at the same time, which was a positive. But look, like you said, if it felt very uncertain in early April when we had tariffs announced for the first time, and everyone was panicking, and no one knew what the answer is going to be. And sometimes that's always a good place to be, because when you don't know what's going to happen, then central banks, governments, politicians, they then plan and they start to unravel things. And who would have known in April that you're going to get most of the tariff deals done through the course of the year? But if you go back to COVID 6 years ago, the low in COVID was actually in March when we were in lockdown.
Yeah.
We didn't get the vaccine until November. So markets move in anticipation and ahead of events by about 6 to 9 months on average. So we're looking forward 6 to 9 months from now, and I said the outlook's pretty positive as we go through this year. So, and then like we touched on, being in that uncertain environment when markets are at the weakest was the best time to invest. And you can see the return that were delivered for the year. So FTSE was up 24%, so that maroon line there. Europe was up slightly better at 26%. And the US actually had a bit of a weaker year compared to what's done over the last, 5-10 years with technology and everything that's driven it. When I say a weaker year, it was still up nearly 10%. So it's not a bad year in hindsight. But this highlights, back to the point, take your time, don't panic when markets are weak. Corrections come. I wish markets went up in a straight line. It would make my life a lot easier. It would make clients' journey a lot easier. But it's about being patient and investing for the long term, because if you panicked in COVID, if you panicked in April last year, you wouldn't have had the rebound, and markets now are back to all-time highs.
I think as well that chart highlights, that things don't always stay the same. In for the last 15 years, nearly, the US has been the driver of returns, and kind of often client conversations start to should we just, you hear it a lot, should we just be in the US? Why would we be anywhere else? And the story can be quite powerful. You see all these big technology names and you think, well, surely that's better than your more older style UK companies maybe. But this highlights why remaining diversified at all times is so crucial, because no one could have necessarily predicted what was going to happen over the last 12 months. And it might be easy now to flip back the other way and say, well, now the US is dead. Let's change that. And it's about, in all scenarios, just trying to take a balanced approach with everything. Don't try not to panic. Don't get too excited, and keep the long term in mind, because these will all average out, and it's about having a smoother path as possible. And when you pull all of those together, you get the average of them, and that's why you do it.
That's Warren Buffett's philosophy about swimming against the tide as opposed to swimming with the tide.
Yeah.
When others are fearful, you be greedy. When others are greedy, you be fearful.
Yeah.
So, you just mentioned something there, Alex, with regards to America and how well it's done. A lot of our clients are saying, well, that hasn't really pulled through, but we're also looking at the strength of the dollar when we're looking at the US markets as well. So it might just be worth touching on, because the dollar's actually weakened the pound strength, and that's had an effect on certain returns as well, hasn't it?
It has. That's a fantastic point, because people, when we're buying the US market, and most investment managers, to be honest, you're buying Facebook, you're buying Apple, you're buying Microsoft, you're buying their shares, but you're also buying the dollar at the same time. You can hedge exposure, and we have done that from time to time, but most of the time we don't, because we're not good at currency forecasting, to be honest. And you can. This is the dollar weakness that we saw last year. The dollar was down. My bar's hiding it. Is it 10%? It's about 10%, isn't it? 9.3. 9.3 for the year relative to the pound. And it's actually been a little bit weaker as we started this year as well.
Correct.
And you look at it, and it's all principally the first 4 months of the year, really, where that weakness came through, and then it's steadied out from April. So principally linked to Donald Trump and policy, and there's no easy way of saying that, because effectively what Donald Trump, when he took office and introduced tariffs, was to put two fingers up to the world. It's causing arguments with every global economy, every global nation that you can shake a stick at, whether it be close countries like Canada or Mexico, or it be China or the UK or Europe, whoever it is. It was a global fight. And that's ultimately annoyed a lot of people. And I think the comments this year have annoyed people even further. And look, we as investors and individuals all have a choice. There's quite a lot of statistics coming out at the moment about people in Canada who just stopped buying US products. I was speaking to a friend over the weekend, and it's just little things like, I'm not going to the US on holiday while that idiot is in charge.
Yeah, sure.
And there's people just not putting money into the US.
Look at the World Cup. There's nations talking about boycotting it.
Yeah, exactly. And that has an impact. And not just that, this is also at a time when The US has got record levels of debt when it's outside of war. And the people are getting concerned about the ability for them to keep repaying this high level of debt. So there's a lot going on with the US at the moment, and it's really started to impact the dollar. And I don't know when it'll happen. It's maybe 10, 15 years down the line, but the US dollar is the reserve currency of the world. You know, you look at gold, you look at oil, it's all priced in dollars. Now, at some point, if this carries on, and it can't always carry on because he's not going to be in office for only for another 3 years or so, unless he changes the rules. But that's going to have an impact over the next few years in terms of people's perception about investing in the US economy. So, yeah, that was a headwind. So when I say the US market was up 9% last year, that's to a sterling investor.
Yep.
So it would have been, if you're a local investor and you didn't have that currency risk, you would have been up about 15%. I think the figure was in dollar terms.
And I think that highlights the point where the markets are doing well, but sentiment is still waning. It's behind the curve a little bit.
Yeah.
And one of the things you mentioned it before that's affecting that is waiting for the impact of lower interest rates to come through.
Yeah.
You know, particularly in the UK, people are still on 2-year, 5-year fixed rates.
Yeah.
Looking at rebrokering some of the deals, when then they will start feeling those the reduction in the interest rates and feel it in the back pocket. So do you just want to touch on what effect the US and the UK is going to have on interest rates, what we think will happen with interest rates over the next 6 to 12 months?
Yeah, sure. So let me just stop sharing that. So let's start with inflation, because inflation is what has triggered interest rates to move the last 5 years. We had significant levels of inflation back in 2022 when Russia invaded the Ukraine, and we know the reasons for that. Commodity prices were higher, energy prices were higher. Our heating bills went through the roof. That slowly drifted away and come off. And that's why the Bank of England cut interest rates 4 times last year. So brought them down significantly. And the US has gradually followed suit as well. And as we look through this year, we're expecting inflation probably by April, May, excuse me, to get back to the Bank of England target of 2%. And we're at 3.4 today. So that's quite a steep fall in a very short period of time. But we can easily see a path with that happening. The second thing is the employment market in the UK has really, really deteriorated. And to be fair, in the US, unemployment is now the highest level since the pandemic. And the pandemic's a bit of a weird one because you also had furlough at the time, which kind of artificially kept unemployment lower. So I think the Bank of England are looking at, you've got slightly weaker growth, you've got unemployment which is coming down, so you want to cut interest rates. And the new normal for interest rates in the UK is going to be around 3%. So we're at 3.75. We think we'll probably see 3 interest rate cuts this year to get down to 3%. So that's one of them going to happen here. In the US, you've got the interesting thing of, sorry, can I just take a little bit of In the US, you've also got Jerome Powell's time at the Federal Reserve coming to an end in May. And Trump has been very vocal about the fact that he wants to bring someone in to help bring down interest rates. But whether that's going to come through and you'll get a puppet, it's hard to say.
There's not many takers, is it?
But I mean, if you're going in as head of the central bank, as an independent global central bank, and everyone else is rallying around you, then there's going to be pressure for them not to collapse as well. But that being said, inflation is coming down in the US. So unemployment market's weak there. So we think interest rates will come down gradually in the US as well. I think it's sensible. But we're not going down to 0. We're not at 5. We're kind of going to be in that mid-range now.
Okay, good. And Chris, what effect does that have with some of our clients? Because there are still alternatives and there's still good returns that you can get in terms of cash and gilts and alternatives to people who might be a little bit wary of going into the stock market.
Yeah, absolutely. I think certainly conversations at the moment, there's a clear sign that interest rates are coming down. On you're having to probably work a bit harder to get your best interest rates. Probably a year and a half ago, most high street banks were giving you pretty competitive rates, and now you're having to stretch a bit further and maybe look at more challenger bank style banks to get your 4% plus interest. And it seems to be a kind of I think a mental barrier of when it goes from 4 to 3 that suddenly it's a lot less attractive. And I think I've spoken about it before. One, your cash a lot of the time isn't there for the return. It's there for the security. It's there for the knowing what it's going to be in 6 months, 12 months, a year's worth time. And it plays a really important role, so that if we do go through a spell in the markets where things are a bit tougher, that you have that buffer to fall back on. And it's less about, and actually, to get the better rates, sometimes you've got to fix it for periods. And sometimes, the conversations we're having is this part here isn't about getting the best rate possible. But, if you do, look a bit further afar than your high street banks, there still are decent rates available, kind of still about 4%. But the alternative as well is gilts. So, UK gilts, despite kind of the Bank of England interest rate coming down, that the gilt market themselves is still fairly positive, and depending on your tax situation, it can also be pretty tax efficient. So there's certainly alternatives, to cash out there. Often it's all about resetting that conversation around, why was that cash there in the first place? Is it still needed there? Is it just a comfort thing for the clients that, whilst they were getting a good return, they were happy having it there? Should it now be invested? Whether that's higher risk or even a medium risk, to get a better return, or is actually the purpose of that cash still the same, that it's there for its instant accessibility and security, as opposed to the return that you're looking for?
And that's available in personal monies, corporate pension monies, charitable monies.
Absolutely, yeah. Whichever type of entity you are, individual, corporate, there's always options. There's different systems to get the best rates, and kind of not have to set up an account with every single one. I'm sure people that have set up any account anywhere recently, the amount of kind of hoops you have to jump through. So yeah, there's certainly options out there to kind of make things like that a bit easier.
Yeah, and one of the things that obviously we have to look at, even if cash rates are running at 3.754%, depending upon where they are, the tax implications, because they're gross rates if it's in bank savings. But then you mentioned before, Alex, about inflation, and that will erode the return. So sometimes, even if you are getting those 4% rates, but if you're getting 2% or 1%, I saw one of my clients the other day, and they'll get 0.75 on £1 million.
Wow.
And so we were just talking about it. You've still got to pay tax on that, but then you've got the impact of inflation eroding it in real terms. So it's something that we have to think about structures, what rates you're getting, but obviously the tax implications of it as well.
Well, that's a negative real return. I think you've got interest rate, cash rates at 0.75. You've got inflation at 3.4. You're losing that difference there, aren't you, on an annual basis? And people don't feel it. I mean, you had food price inflation up this morning, and that was higher again. So there is still a bit of inflation, and that's the stuff that inflation people notice as well.
Correct.
And I think as well, actually, even thinking about, if you're a married couple who's holding the cash, is if sometimes it's, if someone's received a boat, whatever it may be, and it's natural to keep it in one person's account, but actually if they're the higher rate taxpayer and the spouse is a nil or basic, well, actually just shifting things around like that, you can be getting the same rate before tax, but then ending up in a better position. So, stepping back and reassessing what the cash is there for, and is it actually held in the right name and in the right structure.
Okay, and having a wee review of your circumstances. And I think that's coming all to fruition, particularly with the changes in some of the budget, where financial planning is becoming, it's not about returns all the time, it's about financial planning and tax mitigation.
Yeah, sure.
Yeah, absolutely. I mean, and certainly the last 2 years have highlighted the chopping and changing. We've obviously, there's going to be an increase in the tax rate on interest. So you're always having to keep things on review, because plans that were set up even a year and a half ago are effectively out of date if they're not regularly reviewed. And we saw, interestingly, the post the budget back in end of November, that I think it was just before Christmas, I think a lot of people had clocked off, and there was then quite a significant change to business relief and agricultural relief that was increasing the limit from £1 million to £2.5 million per individual, and it's a significant change. But it certainly highlights that the government was having a budget 3 weeks before and potentially hadn't decided that they were going to be doing it at that stage, and then just before Christmas rolled that out. So you've got to keep things on review, and I mention it time and time again. Now is no better time to be reviewing all things, your wills, how things are structured, changes like that with businesses, that's will have a massive impact on people. So it's about reassessing things and factoring in the changes we've had. Certainly not trying to second guess what might come next. Depending on who you speak to, some suggest there might not be a need for further changes or tax rises at the next budget, but obviously that was said prior to the last one as well. So
Yeah.
And also having a look at how your assets are held and where the income's derived from, whether it's capital gains, whether it's rental income, because dividend income, because we're seeing a little nudge on some of the tax rises there, but also keeping your allowances at the same level, and that the effect of that having a stealth tax, that's the biggest tax increase.
Yeah, and I think that people don't appreciate that. I mean, the amount of conversations you say, it's been frozen now for 5 years out, and that's significant. And if people are getting a pay rise of 3 or 4%, more people are just gradually creeping in. And that was one of the things that came out at the end of last year, that the revenue coming from wages and tax on wages was actually a lot higher last year than people had expected, because that started to be felt already. And you fast forward 5 years down the line, that's going to be even more significant. It's quite scary, the amount of tax that we're all going to have to pay as individuals now.
Okay. It really does highlight the need for individual planning around, what is the most suitable structure for your assets, because, with all the changes that have happened and happening, it's easy to focus on what was the return on the portfolio, but you have to think about what does that actually mean when it's coming into your bank. It's no good getting a great return if you're losing 40% of it to tax. So it's really important that planning within the family to make sure that everything's as efficient as it can be.
Yeah,
good. I'd agree. I'd echo your sentiments, Chris. So that's where we're up to today in terms of what's happened in the past, where we are in the markets. Without the crystal ball, what do you expect to happen with regards to stock markets going forward? We've mentioned they're at an all-time high. Is it a good time to invest? Should clients be a little bit wary? Should we be expecting a fall, a correction in the markets?
Yeah, let me share some slides on that. It's just easier to talk through. So just give me a second.
Whilst Alex preparing that, I think one thing that certainly since the start of January that's been highlighted is politics is often what gets the headlines. Yes, when the economic data is released, it will be there for a day or so, but it gets quickly forgotten. But we've seen with Venezuela, we've seen with Greenland, but we've seen it in the past week with the Labour Party and Andy Burnham, and I think sometimes it's easy to get too caught up in the politics side of things, and it certainly can have an impact on market returns. But looking back through history, there's countless political and geopolitical events that when you step back and say, well, what is the stock? What are we investing in? You're investing in companies whose earnings might be impacted by politics, but actually a lot of the time they're immune to that. So sometimes it's trying to step back and say, will we still be talking about this in 6 months, 12 months time? And if we are, then maybe it is a risk to the market. There's a good chance what's happened in January might have already been forgotten about.
And as I say, today's news is tomorrow's history.
Yeah, exactly. I mean, so just to circle back to that question then, it took me a while to get there, and I think I've scrolled through about 20 slides, so apologies everyone. So the first thing when you invest in is the price that you pay for something. That's always the most important, whether it be buying your house. Buying your house in 2007 versus buying your house in 2009, the value of it was a significantly different points. And investing in markets are no different to that. So this looks at equity market valuations. So you've got most global stock markets there, China on the right, emerging markets, UK, Europe and US. The grey bar represents the range that valuations have been in since 1990. So if you're towards the top, that means you're more expensive on a price earnings ratio basis. If you're near the bottom, it means you're cheaper. And what happened last year, we showed the chart before about how well markets did, and that's because markets repriced, so markets became more expensive last year. So that's why Europe and China were up 20-odd%. And you can see that on the chart there. The purple diamond is where we were at the beginning of last year, and the blue diamond is where we are today. So I think the first thing to say, the green limey line, that's a very interesting thing to say, isn't it? Is the average since 1990 as well. So quite a long history. And you can see there that most markets, particularly on the right, look averagely priced. They're not expensive, which is always a good place to be. The areas that do look expensive is the US. And I'll touch on that quickly now. In The US stock market has done particularly well the last 5 years. Technology, AI, Chris mentioned it right before, and those companies have been re-rated to be more expensive. What I would say with that as well is these companies are the highest margins, the most cash generative, the safest balance sheets that they've had for a long period of time. So you could argue that they should be trading more expensively, but it's something to be mindful of because a lot of that growth has already come from future years to put it into today's price. So what we're looking at on the left-hand side here is what's going to drive markets. It's back to what Chris says, you're investing in companies, you're not investing in individuals or government, you're investing in businesses and their ability to grow earnings to shareholders. And on the left-hand side, you can see what happened last year in grey and the expectations for this year in that, again, the line bars. And you can see there that the line bars, the green bars, are above the grey bars consistently across all global regions. That's a positive. That shows that you're going to see potentially the market is expecting decent earnings growth this year. And the other thing to mention, back to that diversification point that we mentioned right at the beginning, that's everywhere. You're seeing it in China, you're seeing it in the UK, you're seeing it in Europe. In Europe had negative earnings growth last year, and it's expected that it'll grow by nearly 15% this year. So that's pretty significant. And that's what we think is going to drive markets this year. You're not going to get that valuation increase that you saw last year. It's going to be about earnings. So if earnings keep growing by 10 to 15%, that means the market can grow by about that. I mean, you're going to get some of that in dividends. You're going to get some of that in share buybacks, but you're also going to see that in share price appreciation as well. And then on the right-hand side here, it's about what revisions are coming through. You want revisions to be moving higher. And you can see, I mean, the US revisions are actually coming down. The UK's plateaued a little bit, but Europe has been a lot stronger, having had expectations at rock bottom. So as we look forward, the revisions are starting to improve. Earnings look pretty strong. And it all principally, back to that first question you asked me, it's all underpinned by global growth. Companies grow when economies are growing. And then companies can grow faster or slower depending on what they're doing and their ability to, what they're developing or creating, things like that. But again, yes, we're at all-time highs. But if you think we've got a bit of inflation, we've got some growth, then companies' earnings can grow and markets can continue to move higher. Now, I'm conscious that you asked another important point as well, can we expect a fall? We should expect a fall every year. It's not, as I said right at the beginning, I wish markets would just go up like that and it'd be nice and easy.
You'd be out of a job though.
I know, wouldn't I? So there you go. And on this chart, goes back to 1986, so 40 years this year. Those red dots represent what happened in the worst point. So from the top of the market to the lowest point, what was the fall? And typically, stock markets fall by 15% every year. Last year was almost a perfect example of that. Market was down 13%. That was in that April time period. Ended the year strongly. The other important point about this chart is the bars. That shows what happened in the year and up to the end of the year. And you can see 3/4 of the time markets are positive. So you should expect more positive years than bad years. But every now and again, you're going to get a bad period come along, as we've seen, whether it be financial crisis, COVID, European debt crisis, inflation, interest rates and wars, etc. And who knows when those events or shocks can happen. No one can forecast them. If you went into the beginning of last year, who would have expected the tariffs to have the impact that it did in April? So we don't know, but one, expect volatility, and it's probably healthy that happens as well, because it means that valuations don't get overstretched and it just brings it back to normal. But again, the way we sit here today, bit of inflation, bit of economic growth, companies doing well, good time to be invested.
And that goes back to your point, Chris, about time in the market, remembering why you've invested. It's not about short-term volatility. And actually, when we sat with clients, we want a little bit of volatility for someone like Alex to be able to take advantage of that and re-diversify the portfolio.
Yeah, absolutely. The volatility is there. That's why you get the higher returns. If it was just going up in a straight line, you wouldn't get the higher returns. That's the kind of price of entry. And I think it's crucial at a time like this. And I know you touched on it. Is it a good time to invest because we're at all-time highs? Often you hear the classic, but buy low, sell high, and all of that. But the hard thing to do is actually know when it's actually the high, that it's the last high for a while, and buy when it's at the absolute low. And time again, it's proven it's nearly impossible to do. And certainly we were having conversations at the start of last year when sentiment felt negative because of the budget. Things just didn't. We'd had a good couple of years, so it felt natural to assume that maybe the next year wasn't going to be as good, and we've just had actually another double-digit year. So it's always about not trying to second guess what might happen, and just because we've had some good years doesn't by default mean you have to have bad years. And certainly, as the chart Alex just highlighted, it's normal to have falls within years. That's part and parcel of investing. You shouldn't expect it to just tick along without any volatility. And certainly, it's a good time now, when you have had a strong period like we've had, to reassess where your money is allocated. If you were sitting down and doing a plan a few years ago, and we said we need a return of X%, well, actually we've had some good periods. Can we? It's not necessarily de-risking everything, but can we secure some of that and put more in cash, ready to fund the next couple of years' expenditure and things like that? So it's a good time to reassess things, because actually, if you are nervous, and maybe it's a sign that things should be rejigged a bit. But certainly, just because we're at all-time highs doesn't mean that it was highlighted last year. We were at all-time highs at the start of last year, and we're now there again. But certainly, it's not just a kind of sign that because we're there, we now need to panic or sell out. It's certainly, and at the same sense, if it starts to fall or there is a correction, as highlighted by that chart, it's also not a reason to suddenly cash it all in and wait on the sidelines.
And just want to touch on something that we do at Luna as well, is we're actively managing portfolios as well. So let's say you had 60% invested in equities, markets went up 20% last year, you get to 72% weight in equities, everything else all being equal. Then what we're doing is we're bringing it back down to 60 as well, so it's being managed within the risk. So you're not just, because if you got to 72 and then you have a 50% fall in markets, then you're going to have an impact on your overall portfolio. So, and then I said Japan did well last year, Europe did well last year. Trying to reassess that and bring that back into line as well.
And you mentioned holding assets and different assets, and trying to find out when's the right time to come out of the markets. That's not what we do. No. We're financial planners. We look at the structures, the buying and selling, Alex. We outsource to someone such as yourself. And we'll touch on gold because it seems a nice segue in, because we've been talking about that over the last couple of weeks, and the price of gold and also silver. If you have a look at gold for the last 10, 15 years, there wasn't very much return in gold, and people were always asking, why are you holding gold? And you have a look at some precious metal funds now. It's we can see why you have a well-diversified portfolio and you hold on to these stocks, because, well, some assets are doing well in geographical sectors and industries, others won't be.
I mean, so gold has got almost the perfect storm at the moment. You've got interest rates which are coming down, you've got geopolitical issues, and you've had what was probably the most significant was, as I touched on a while ago, in 2022, when Russia went into Ukraine, global economies, global central banks froze all Russian assets, whether it be in euros and in dollars. In Europe, they're talking about potentially using that as a loan to Ukraine. But the biggest assets was in US Treasuries. And I'm not saying another war's coming, but that's freaked and spooked global governments, because they're worried that if they did something similar, then their US Treasury assets are going to be frozen. The US Treasuries is the biggest asset base in the world.
And we've seen a big sell-off, haven't we, with Denmark selling their US Treasury bonds.
Back to that point that we mentioned before of people just turning their nose away from buying US assets.
Yes,
Japan is the biggest holder of US debt. So who knows what's happened there. If there's a potential trade conflict there, the easy way to get to them is just by selling their debt, and the debt yields go up, and then suddenly it's more expensive for them to fund their debt, which is what it's kind of like a bit of a Liz Truss moment in a weird way. It becomes more expensive. So people have been looking for other assets to benefit, and gold has been the asset that people are focused on. And then when you look at gold, it kind of filters down to other precious metals and other commodities. So silver, I mean, the silver went through $100 on Friday. Yesterday it's 110. Went up 10% yesterday.
You are holding it, aren't you?
We are, yeah. we and we're buying silver miners, which are as the silver price increases, they're leveraged to the price of silver, so they become more and more profitable the higher the price goes. So the miners are actually done even better. Now, we bought gold actually in portfolios a year ago. So gold was up 40% last year, which is quite astonishing. I wish we bought more. But again, gold price has gone through, is it 5,000? I think when it went through this. Yeah, 5,000 it went through yesterday, and it's all on BBC News and things like that. So that's the next stage. You then get speculative buying. What I would say is when it's up 40% in a year, maybe expect it to consolidate a little bit. It's the perfect storm at the moment in terms of the reasons behind buying gold. So we would expect it to come off a little bit, and that'll be healthy. But longer term dynamics, people are still going to be selling US assets. And it's the beautiful thing I like as well is that these governments are buying are price insensitive. And that's really important because they just want to get out of treasuries. It doesn't matter to them what the price, and they want to buy gold. So they're diversifying their assets. So as bonds mature, they'll just keep buying gold. So they've just got that natural buyer coming through all the time. And just, I've mentioned silver. Silver is always very correlated to what happens in gold. Silver was up significantly last year. But silver, as well as being a precious metal, is an industrial metal as well. So it's used within solar panels, it's used within electric vehicles. So the demand for silver is significant. And final point, you can tell I'm a commodity bull at the moment. It takes a long time to get a mine on stream. 7-8 years potentially to start mining operations. So, and because of the world we live in about it's unfashionable to dig holes in the ground, then you're not seeing governments approve mining projects. That's what Trump's actually trying to change in the US, but he's not having much success doing that as well. So again, the supply of gold, silver, copper, etc., is restrained at a time when demand is accelerating, and hence the price is just on bananas and through the roof.
Okay, good. And Chris, with regards to clients, and do you just want to run through? We know that we like our MPSs, which is a managed fund, just how some of those work with regards to diversification and holding assets.
Yeah, absolutely. Yeah, so there's different ways of kind of implementing different investment strategies, and our job is to assess which is most suitable for clients. So everyone has different goals, different time horizons, crucially, and also different tax structures. So depending on whether it's in an ISA or a pension or an investment account, might drive whether it's in a multi-asset fund where it might all be held within one fund, but still be very diversified under the hood, or it might be in a kind of portfolio of funds where you can dig down and see, there's my US allocation, there's my UK allocation. So, firstly, our process is to start with one, what your goals are, what your plans are, and that drives the decision around then, the tax structures we're using and the most efficient way, and then it will move on to, how's the best way to implement the investment strategy that we're looking to use. Also driven by obviously people's tolerance for risk and things like that. So there's lots of options, and it's very personal to each client. Certainly not.
And it is transient, isn't it? So that will change throughout a client's investment journey.
Absolutely, yeah. But both on a kind of ongoing basis, when we're assessing who's suitable managers, etc., but also on a as you move from maybe a saver to a spender, then actually you might need to rejig your strategy a little bit, and where you're targeting income instead of as much capital growth.
So we've had a good review of what's happened last year, where we're up to. Sentiment maybe a little bit behind the curve. There's still positives in the market, we think. There's still geopolitical risk. What do we think the bad news might be out there that we should be looking at, taking into account?
Oh, it's the unknown unknowns, the things that you don't see come in that you're not aware of. And that's the beautiful thing in what we do, is something can come along out of the blue and impact it, whether it be regulation, whether it be government change, etc. At the moment, the concern is around private debt and the amount that's been put into artificial intelligence. That seems to be one. One is valuation. If these tech companies in the US can't keep growing and they're expensive, and it's going to be an interesting week actually, because we've got the Magnificent Seven reporting this week, that could impact investor sentiment on markets. But as I said, and you mentioned it as well, to be fair, Stuart, these are the times when these events do happen where you take advantage of that, and if it's the right time and you think that the economic picture is going to be fine, you buy the dip. If you feel that you're going to go into a recession, the economic picture's changing dramatically, maybe not. But at the moment, we're in that kind of world. It's going to be okay. No recession looking unlikely, and we'd buy the dip and take advantage of those opportunities.
Yeah, I was watching a programme on Trump the other day, which wasn't a comedy, but felt like it at some point. And no matter what people think about Trump, good or bad, he has forced Europe and NATO's hand to invest in certain things, such as spending and defence.
Yeah.
So, and that might have been one of his priorities. It might have been an objective. It might have been an outlier. But there are opportunities when there is uncertainty, isn't there?
Exactly. I mean, we saw that in COVID. I mean, who would have thought in COVID people would have been able to react, and businesses change their business model and etc. very quickly to cater for the new environment that we're in so many different ways. So there's always opportunities. It's just about being. I think initially there's always that shock, that fear factor of what's happening. Then people get into gear and they start to adapt and change. And that's we see that all the time.
Chris?
Yeah. I think that recent years has highlighted to expect the unexpected. I think you go back 5 or 6 years, we've had a pandemic, we've had invasions in Europe, we've had Donald Trump. I suppose go back further, and him being elected in the first place probably was the sign that things aren't going to be normal anymore, and not that they were before then. And I think that's often the thing. It's easy to think that the thing that's happening now is going to be the thing that leads to market falls or whatever it may be, but you can only look back in history and there's always something going on. There's always something to worry about, and it's sometimes just trying to filter out the noise. And as I touched on, every client's different, every situation's different, and it's try and focus less on what's going on in the world, more on your situation. How can we manage the things that we can control, and then protect against the things that we can't necessarily control, but we can manage. So it's trying to not second guess where things might come from, as you said, Alex. It's the unknown unknowns that you don't know what's coming next, but you can be in a balanced position and a diversified position, so that depending on what it is, the impact can be limited. And
we mentioned time in the markets. It may be that with technology that the peaks and troughs become a little bit closer together. So
I saw that in the past with it can concentrate on a particular sector very quickly. So people concerned about US banks came into pressure significantly. People can move their money around a lot quicker than they did in the past. So you're right, and you put around that social media and this medium of people making decisions and being maybe less patient than invested, things can turn very quickly in certain areas as well.
Okay, good. So that's the main part of the webinar.
I was going to say, we've got these poll results as well.
I was going to say,
yep. Sorry.
Well, I can't do it because you've taken over as being the host today.
Share the results. Here we go.
So, I mean, I can't see that, Alex. I don't know if you wish to read the question.
So, what are your investment concerns for 2026? The biggest one, but 58% is market volatility. Understandable, I think, as we said, but that's also something that should be expected. That's something that we see every year. And volatility is where the opportunities come. I don't know if you guys have got any further points on that at all.
Yeah, I think there's always will be volatility. The only way of reducing your volatility is either completely reducing your risk or sitting in cash. But the reason that you've come for advice in the first place is not to kind of have the easy answer of what might feel most comfortable in the short term, but it's about putting your long-term interests at the forefront. And to do that, you have to often take some risk, and the result of that is you will have some volatility. But that comes back to always, with your financial planner and your accountants and tax advisors, etc., keeping things on review so that volatility won't be the thing that suddenly means your plan isn't gonna last, or is it? And that's where things like having a cash buffer, I mention it all the time. What you don't want to be is fully invested at a time when there is the volatility and it's the point that you're about to draw on your funds. If you're in your 30s and you're saving in your pension, you've got time to ride out the market volatility, and actually you should be hoping for market volatility as your regular contributions go in. But if you're 2 years away, a year away, retiring next week, that's where you need to have plans in place so that if there is volatility, that's factored in, and that isn't going to be the thing that then derails your retirement or whatever it may be.
The only thing I'd add is volatility can be your best friend if you take advantage of it, or your worst enemy if you react to it.
True. Yeah, look at we have lots of people that were so concerned in April.
Yes.
That were thinking about selling.
Yep.
Imagine if they'd done that and then they'd missed the rally that we saw from to the end.
And the rally's so quick.
Yeah.
The other thing that I would say, there's something for some of our listeners, the efficient frontier, and it's about making sure risk is arbitrary, volatility and your capacity for losses is quite definite, and you can work out exactly where you are. And if you're a risk profile 5, but not maximising the return, then you can bring down your risk to take a lower return but more acceptable volatility, or you can increase that and try and get a higher return. So it's worth working out where you are on that efficient frontier and try and get on that curve to maximise your return for the volatility that you're willing to accept.
I was going to say, and look, ultimately, if you are concerned about risk and market volatility, then you can still make decent returns in a cautious portfolio at the moment as well, because we touched on, if you're moving up the risk ladder from cash, you've got government bonds, you can then buy corporate bonds, you can still get 5 to 6% return on a cautious portfolio at the moment. So you don't have to be taking a lot of equity market risk just to get returns. If you are worried and you're more cautious, then now's probably the good time to be assessing the risk that you take in your portfolio and thinking about that. People think about it at the wrong times. People should be thinking about reducing this risk if that is a concern later on. What's interesting is we haven't got liquidity conditions, and I suppose that makes sense with interest rates coming down, mortgage rates come down, credit card borrowing comes down, banks are more willing to lend. You see mortgage approvals increase at the moment and mortgage rates being more effective, which the government will want as well as part of their policy to get more people being homeowners in the UK.
So the second question was, which of these areas do you consider the highest priority in the current environment in terms of the answers?
We've got retirement strategy as the top one, and then we've got investment allocation, followed by tax planning. So retirement strategy.
Yeah, well, interestingly, I think pretty much all of that ties into your retirement strategy, getting your tax planning in line. I think cash flow and budgeting, certainly the cash flow element to it for your retirement strategy is absolutely crucial, of knowing where your income's going to be sourced from, having the right risk profiles for those different buckets that you're using. And I think sometimes actually tying back into the first one, fear around market volatility, is having a plan that you can see as to how things are going to map out over the years, and actually being able to say, what we do a lot for clients is stress testing those plans and saying, well, what if we have a year when the market's full by X%? And we can model that and say, well, look, even with that fall factored in, and we know that often after a fall, you get kind of above average returns from the kind of following years. If your plan is still sustainable, that can hopefully give you the confidence, one, in your retirement strategy, but also that volatility can be painful at the time, but your plan is still suitable and that you're still in a place to kind of achieve your objectives. And I think certainly, the retirement strategy, I think, we're having conversations with clients all the time that business environments are changing, things are changing, and sometimes people are just getting fed up and maybe bringing retirements forward. We're certainly seeing that, and sitting down with your advisor and mapping it out to see if it's feasible, and then getting that plan in place. We must have clients retiring every week here in terms of with solid retirement strategies, and that's our job at the end of the day, is putting people in a position that they're confident that when they stop work, they can stop it for good and not have to go back when they might not want to, but also being able to adapt the plan based on people's objectives, because some people
change of circumstances,
and you said
legislation.
Some might just say, at this age I want to stop and never work a day again. Others might want to phase into retirement. So we can plan for all these different options, and really what I say to clients is about giving them the confidence that they can do what they want to do, and then that they can spend what they want to spend, because it's easy saying on a spreadsheet you can retire, but then actually giving the clients the confidence to then spend how they want to spend and not keep worrying about volatility all the way through retirement.
Yeah, the only thing I would add to that is that death in taxes, some of the best return can be to mitigate the tax that you actually pay. So that can be some of the best return in terms of paying into a pension plan, etc. The second thing that I would mention is it's great while you're alive, and we can look at cash flow planning to help model that through. for listeners out there, clients, introducers, I can't stress enough the importance of having an inheritance tax review. The changes in business relief, agricultural property relief, the changes in inheritance tax on pensions, it's all going to be brought in.
Yeah.
There are things that we can do out there. There are things that we can work with introducers and tax partners to mitigate the tax to ensure, one, you get maximum return while you're still alive, but also when you look at some intergenerational planning, that your children will get the maximum out of your estate.
Yeah.
And then the third question, the last question was, which factors are affecting your economic outlook the most right now?
Political tensions.
Comfortably the leader, isn't it?
Yeah.
I think, that's kind of going back to my point that these might have been answered before I made it, that, politics is what makes the news. It's what hits the headlines. It's Donald Trump, I don't know if you can tell, quite likes to be the centre of attention. So he's going to be making, keep doing what he's doing, but it's about always stepping back and thinking, yes, they will often have short-term impacts. We've seen it since the start of the year. When I think he said that he's not afraid to use some force. Suddenly the markets fall a couple of percent, and then it feels like is it now going to be a time to panic? And then a day later, funnily enough, we've agreed a deal. That he likes his deals, and things have bounced back. And it's trying to and I think it's a good example is kind of coming back to the UK side of things is. Since Labour came in, whatever your views on left, right, Conservatives, Labour, Reform, whatever it may be, we've had what feels like a negative sentiment period, yet the markets, the UK market especially, is completely disconnected from probably how the politics feels and how the headlines suggest. Yeah. So, if that's the biggest fear, I would say close your newspaper and,
don't
get out of the fresh air.
Stop reading Donald Trump's tweets.
Yeah.
Good. So we'll just look at a couple of questions and answers. There's one around deglobalisation. With Mark Carney's speech, do you think there'll be some form of deglobalisation? Do we think that there'll be new trade relationships, the impact with regards to China? So I don't know if you want to quickly just touch on that.
And trade relations side.
Trade relationship side, yeah.
Who knows? I mean, you've got UK going to China at the moment. Feels like everyone is working to try and get better trade deals globally because you've had the US which closed off, which makes sense. China did it last week. So
you've seen it with Canada. Canada's had a 16% increase this year, hasn't
exactly, it? But what's the impact that the US then retaliates on as well? So it's kind of there's a lot of balls in the air. And look, I'm not a political expert in terms of tariffs. I don't think anyone is because, as Chris said, they could be there one night and gone tomorrow. So I think it's just part and parcel of what we do. But equally, you've got to remember the US does need resources. They can't manufacture everything in the US. It would be silly to be able to do that. This is one of the reasons globalization took off. It's the cheap manufacturing of goods globally, which has gone to the US. So ultimately, I think, some common sense will come. It might take a bit more pain to be able to get there. But we saw this last year. And I think last year is probably going to be the peak of tariff uncertainty because it was global. You've now seen agreements been done. I mean, some of them have been ripped up, but most of them are actually in place. And that should provide some calm. But then Trump will eventually do something like he has done the last few days and it'll spike a little bit. But it feels like it's political uncertainty was up there. It's come back down. You're just getting little bumps now as opposed to a big spike again. I don't know if you'd agree with that, guys, or not.
Yeah, I've got not much else to add to that. I think we've got a comment over there.
Oh, sorry. Close your newspaper and get out in the fresh air. Thanks, Chris. There you go. It's the best advice.
There we go.
Good. Well, everyone, thank you for joining us today. Thank you, Alex and Chris, for your expertise and insight onto the markets and the effect on clients' portfolios, financial planning, and a little bit of an insight with regards to what businesses and some private clients should be thinking about going forward. If anyone would like any help or advice, please speak to your usual contact at Pareto or Luna. If you don't have one, feel free to come through to me and we can have a little bit of a chat. So thank you everyone for attending today. We look forward to seeing you in the next quarterly update, which will be after Easter, which feels a little bit too young. Hopefully it'll be a little bit warmer and less windy and rainy as it is today. We got swept off my seat. So thank you everyone for attending. Thank you guys, and look forward to seeing you then in spring.
Thank
Thanks
you very
very
much. Thanks, guys.
Cheers.